But you know what? Today we're going to chat about startups and all that good stuff.
Sure.
So I'm excited that we're getting to chat and learn a little bit more about yourself and what you're up to today. And like we like to do, we just jump right into it. So welcome to the Supporters Fund and OPN's Ask an Angel. And today we're getting the opportunity to chat with you, Jim. And the best way for us to start is if you can share a little bit about your background, kind of where you've come from, where you're at, and where you're going. And then one thing about you that nobody will know.
Oh boy, I'll come to that later. I'll do the easy part first. Let's see. So I grew up in the Northeast of the United States. I was born in New York City, raised in the burbs, and did all my schooling in the Northeast. And followed a lot of different paths. Got married very young, really young, and we had a little boy, little then, and I ended up in banking, really because of necessity. I was really more interested in the arts, but I had the mind for it, so I just decided that I was going to, bankrupt myself. My family was going to starve unless I did something more practical. So went straight to work at a savings bank, and then went to work at AIG, a subsidiary of AIG, and then went to business school at night. So I went to Stern School, got my business degree, was a banker for a while, and then kind of hit a, bad timing, wrong place, wrong time. And, having had a, pretty good career, I was doing Latin America, which was, things had to be right. And then instead of like sticking with it, I actually did a little startup work for some different companies, not really, from the banker perspective. And then instead of just staying in, moved down to Florida, just kind of packed up. I was divorced, moved down to South Beach, Florida, and was managing some money for my family. So I was in the investing side of things, and then fell into really the wrong way into startups. And I say the wrong way because I wasn't doing it directly. I was listening to other people, and made some big mistakes early, as a lot of angels do. I'm sure you've talked to a lot of people, and some people will make a mistake and run, and others will say, shoot, I got to figure this out and I got to make it back. So that's what I did. And this is a long intro, but I'll finish it in a couple of sentences. So basically what happened was I decided that, having done more reading, that the way to do it was to make lots of smaller bets, which is still our strategy at Beresford Ventures. And then I found some other people like me. After I tried the angel group route, which I didn't like, and then I found people like me, and we formed this company, and so that's it. We've invested in 103 companies so far.
Awesome. That's brilliant. And what's the one thing about you that no one would know?
Oh my gosh, can I come back to that? It'll occur to me. I don't know. I'm terrible at like recall. I'll tell you one that's venture related, and actually some people do know this, and he probably would hate to hear me say it, but I played on the JV baseball team and the varsity football team at Andover, Phillips Academy Andover, with Tim Draper.
Sick.
Yeah,
that's pretty cool.
That's a good story for here.
Yeah.
For this setting. I mean, we weren't like close buddies or anything, but no one got that close in those days. But anyway,
very cool. Any things that you remember from then, like a story that you're like,
I do actually. I'll tell you one story that's kind of fun, and the reason I've always remembered it, but it was actually in his book. So his dad was a famous. And look, I don't want to be, comparing myself to Tim Draper. Let's just get that clear. But Tim is, super successful. Has been doing it for decades. Is worth billions of dollars. I'm very much an amateur by comparison. But I did go to high school with him, and so I did read his book and his father's book. And his father was actually one of the original venture capitalists in America, and he worked for the Exim Import Bank. I used to actually, when I was a banker, did work with them. So I understood that, and he was a big deal in the Bush senior, H.W. Bush administration and elsewhere. And so I read his book and Tim's book, which is, it's a little different, Tim's book, but he mentioned an anecdote from football and high school about his friend, I forget his name, but his best friend growing up, they were inseparable, how he went to Deerfield, and when Deerfield was playing Andover, his friend broke his nose because they were opposite each other. And I remember being on the bus going back, and Tim had left the field with a broken nose, and he was on, and he said to us, I think he was a little bit woozy, he said, I asked the doctor if I'd be able to play lacrosse in the spring. And he said, sure. And he said, that's amazing. You're an amazing doctor, because I play baseball. I've never played lacrosse in my life. So that stuck with me. It's not hysterical by any stretch. It's not exactly, high comedy, but I do remember that. So.
And did you remember it because he became famous, or just happened to be?
No, it stuck with me. No. I don't really have so many distinct memories from high school. It was a long time. I hate to tell you, we graduated in 1976. It's a long time ago. So no, certain things stick with you, and I don't know why that did. I couldn't tell you anything else about that day.
Amazing. Well, it's still pretty cool. Well, I'd love to kind of go back and talk a little bit about on the investment side, where you said you ran into the problems and the main things that everybody seems to face. And I'm not sure everybody faces them, but they face and what you did mention, which is that they usually bolt. And that's because I think that there's this perception that I'm going to fly into this new category. I'm going to make a couple investments, make some big money, and then fly out. And it always seems to be the opposite of that. Maybe you can share a little bit about that experience and what was the downside that you came across, and how did you overcome it? Because it sounds like you were doubling down. You're like, you know what, I screwed up and no one's taking my money. I'm going back and I'm going to find a way to
I'll answer question number 2. And the easy answer is stupidity, right? I mean, stubbornness and stupidity is why I doubled down. There's nothing really, I'm not really proud of anything, I can say on your podcast, I'm afraid, but definitely, there's definitely, it was that, it wasn't like I knew any better. So what happened early was, my first investment came through a friend. He didn't really advocate it. He wasn't in the business, but it really wasn't a startup. This was something closer to home. And I'll tell you the mistake I made is I was lazy. I didn't do enough diligence. I kind of just looked at it. It was actually a green power company. It was a solar company. And now, knowing what I know, the structure was horrible. I mean, it was like a cram down. I was like invested with this retail group of investors that were bailing out the early investors. And it was upside down, because the early investors had preferred and we were coming in with common. I mean, it was, honestly, I'm not going to say the name of the company so that they could sue if they want. They're out of business. It was fraud. There was fraud all over the place. So the mistake I made was I wrote a big check. Things looked good. I actually re-upped. I did a follow-on. And so that was a lack of diligence. But I thought I knew what I was doing because it was basically a utility play. And I kind of understood the utility business to some extent. So, I mean, not to a great extent. So that was number 1. Number 2 was a friend, acquaintance of mine, I have to watch what I say, who I knew from Miami. He was a smart guy, worked at a good institution, came to me with a deal. And I wrote a big check, like a pretty big check I would never write today, ever. And things looked good. And then I followed on, because the indication I was getting back was it was great. And I'll tell you, it was in the space, it was competitive of WeWork, which is not a good business, frankly. So, but it was a competitive WeWork. And there was, once again, I mean, with a small f, fraud. I won't go into it. I'm not going to say any names. But so that one would have been hard to uncover. It certainly looked great at the time. And a lot of people made that mistake. But P.S., that thing went, my shares, because they were, we got crammed down by, the company still exists. We got crammed down by later investors. The original management was kicked out under questionable circumstances. And I was out $400,000. No, more. I was out $450,000. My first 2 bets. Now, I didn't know that at the time. It took me a long time. These things dragged on for years. But I was down a lot. And so the conclusion I drew was do it yourself. You're relying on other people. Don't be lazy. I hate due diligence, but do the diligence and get out there. So, and then I started. That's a whole other chapter. And I still stumbled a few times.
Well, it's some good advice on the do your due diligence, because I think I've been pretty adamant about that, and stuck to the same line that you just said, that it's not the favorite thing, but it is the only thing that's going to protect you and your funds, is that you really do dive into these companies that you make investments on. And a lot of the times it does get overlooked. And sometimes it's because it's early in first few investments, you're excited, you're part of a new group,
Right.
or new excitement. And maybe you just follow along with the rest of the gang and just jump in because these other people went in. Are they supposed to do the due diligence, whatever that might be? But really doing your own due diligence on anything that you're going to invest in when it's your time and your money makes a big difference. Is there ways that you now look at it? You've made 100 plus investments. You've got other investments you made before that, before you got into the consortium. Have you kind of lined up things that say, you know what, here's the 10-step process that I follow every single time?
No,
if I don't,
no, I have, and I hate to disappoint you and sort of contradict the advice you're giving your listeners, but I'm still not big on due diligence. And let me tell you how I've sort of gotten around it. The big thing I want to make sure is that there's no fraud, because I've suffered from fraud 3 times, different degrees. One was out and out fraud. I got my money back. And the other 2 were, as I said, these other ones were, never proven. There was certainly a degree of it, but like I said, small f fraud. So the main thing that we do, because we do write a lot of checks, and we don't have, we don't have outside money. One thing about our fund is we're a ledger fund. There are 7 partners. So it's not like we have $20 million under management or $100 million. We've got all this money to pay. So we have our lawyers do the kind of, little bit of, not like background checking, but they check the deal docs, they check the corporate docs, and then really what we're doing is following up other people. We never lead because we don't write big enough checks. It's sort of by necessity. So I hate to say this because, like I said, you don't want to hear this, but we really piggyback on other people's diligence to a large extent. But let me say this, if someone is not really keen on doing a lot of diligence, let me just give one piece of advice. Check your founders on LinkedIn and make sure that they list the company that they say they're running as on LinkedIn as the employer that they're at. If they're not, you call them. Don't write them, call them and say, what the hell's going on here? And if you don't like the answer, move on. That is a really easy one.
Yeah. No, for sure. That's a fast way to detect that. And like what you said is there's nothing wrong with not leading and participating in rounds. You get to know the founder. You're still checking on the company to make sure that it's 100% legit and not fraudulent. And you're doing small checks, but you're small checks into the company. And then you're making that decision to make an investment. And I think that those are still standard pieces that you have to follow because you're trying to adhere to the 7 people in your own group. And the last thing you want to happen is that, you didn't follow a couple of those points. And again, you get defrauded again and find that we
haven't suffered from fraud in 102 deals. I mean, all the fraud in my life was early. I'm in 130 deals or more. I mean, there's a lot of overlap between my deals and our fund deals. That's why, it might surprise you that I'm not in more, but probably 10 or 15 there's overlap. But, it all came kind of early. And the reason that what happens is if one of my partners has a question, then they'll call up like one of the customers, and then we'll get a couple and say to them, can we talk to your customer? So it's not like we never do that, but it only comes up when we feel it's necessary. But remember, I say remember because this about me because we spoke before, but I'm involved with 2 really great accelerators. One of them is in Canada, which is CDL, Creative Destruction Lab. I mean, you get to know the company as well. So technically it's not diligence, but those companies have been screened by scientists, at your version of the National Science Foundation, and then by professors, at the universities. And then we meet with them. I mean, these companies are vetted before I even say hello to them. So you have a high degree of comfort.
Well, and they're investing in them as well, right? They're putting a few dollars in behind them. They're working
Not
with
CDL,
them.
no, not CDL, but other mentors. Yes.
Yeah, correct. So, but what I still like about this, and only because we actually never actually have had the conversation yet about the fraud side. And I think there's a lot of
It's great. Jim Horowitz, fraud. That's why I'm gonna be victim of fraud.
No, but we've gone through it as well. So that's the thing, is that it comes in all shapes of sizes and forms that you don't believe are possible. And in our case, it actually came through not through a startup. It came through an investor that was leading a startup to get investment. And what they ended up doing is they dragged the company on to a point where they were ready to make investment. They gave them a date. They wanted to break ground. So there was an opportunity to do a bridge round to get into the structure of the business. The founders were awesome. The IP was great. And it ended up turning into a massive, drawn out, real fiasco mess. And it all came down to an investor that was literally wasting 2 years of time on the startup, had no intention of probably ever investing. And the end of the story was that the company ended up having to file bankruptcy.
Oh, I see. So it wasn't like the investor embezzled the money, though that has happened clearly in publicly traded companies, on big private companies. But what happened was he just basically strung along the startup.
Yep.
Oh, that's
got it to a point where they signed off on all the paperwork. Everything was done deal. Holdco put the money here. It will be here till this date. The company lined everything else up. They had 4 months to get running and building. And then at that date, big major accident happened. Oh, they couldn't deliver. 8 months later, there was never probably any money there, and everybody had to walk away, fold the company. We lost on the deal because we were the bridge round. And it was a great IP, great company. And then what the worst part of it is that the founders ended up having to not only bankrupt the company, but they split ways. And it was tough because they'd been together 5 years building this all out. And it was pretty exciting, and all because one person decided.
That's the real tragedy. Yeah.
Yeah. And when you start to look at these things and what you went through, due diligence at any form makes a big difference. But now even on our side, we're looking at, man, we even now have to go to the extent of looking at investors to make sure that they're not leading the wrong
investors
way.
Themselves. Yeah.
Yeah, it's crazy. So it's interesting that you bring that up. And I think a lot of the times we all think that all we see on the media is these great stories of how exciting early stage investing is. But no one realizes that there's massive risk on all accounts. Yeah.
I love it. Don't get me wrong. I mean, I love what I do, but everyone says, oh, it's the greatest job in the world. And believe me, I have exhilarating moments sometimes. And I do love it, but it can be very trying. It's a ton of work, and it requires a ridiculous amount of patience. There's not a lot of positive feedback for years and years. So I think people should go into it, understanding the risk, understanding how to mitigate the risk, which is what we're all about. Notwithstanding, what I said about diligence, and then understanding the ups and downs and the patience that's required. I think if I come back to that word because I think it's the most essential quality in an investor in this field is patience. But it's not all fun and games, and you're not going to get that trader's rush that. I think some people go in who have like a trader mentality. It's like, hey, 7 years, 8 years, maybe.
Yeah, those things aren't fast, right? Yeah, I think the immediacy, and you make a good point, because when you start now, as you continue to move this forward and roll the ball forward, is that eventually in that 7 years from now and 5 years from now, you're going to start to get a lot more action happening. As long as you continue to do this every year, then in year 5 and year 6, you should have companies that are starting to transact.
It's like an aging schedule, when you do like an inventory or aging schedule or receivables. If you took like your accounting, what do we call it? I forget what it's called. CFA, credited financial analyst. I remember it from that stuff. And yeah, it's like that. You basically have this, like the first few years is nothing, and then you expect things to roll off. And fortunately, personally, I'm at that, I hit that because I started before the fund's only 3 years old. But we're actually starting to get, we've had one exit. We have, and then two more have been, one is unofficial. I really shouldn't be talking about it. And both of them are unofficial, but it looks like we may have two more before the end of the year. So, if every 12 months we're starting to get 3 exits, that's a pretty fast pace. I don't anticipate that. But if we do, that's satisfying. Yeah, you just have to wait till you get to that stage.
Yeah, and that's all part of that planning. And when we look at things, you look at short, mid, and long-term investments, but it's that cycle to keep it all going. So in your case, you now have a fund where you're building in that in 3 to 5 and 7 years, in these increments, you're going to start having companies that are going to cycle in and out of your process. Some may fail, some will win. But the thing is that as you keep investing and you get to year 5, you're going to have another 5 more years for some other companies.
Oh, absolutely. We keep going. We're only 3 years in as a fund, but we're moving at the same pace. We're doing somewhere around 30 deals a year.
That's incredible. And when you guys are working on these deals, and you mentioned a little bit about the types of diligence you're doing, what are the types of companies you're going into? Is there a specific vertical? Is there an area that you like looking at with these accelerators that really pique your interest? Or have you kind of just left it generic and you guys just through your consortium decide, here's 5 companies, pick 2 and we're going to invest?
Of course. It's really sort of what catches your fancy. I mean, our goal here is to make money. So, we're going to be drawn to something that, we think has a lot of upside, and we're early stage because our checks are small. So we have to be early, which means that in order to justify the risk, we, for the most part, have to feel that if it hits, it's really going to hit. But as far as sector goes, I always say that our specialty is early stage. So we're sort of pattern recognition for what an early stage company looks like. That means understanding the issues to do with boards and cap tables and, sizing their, pre-seed or whatever it is. And you just get good at that. People are always asking me to help them with like their VCs and like the B round. I'm like, that's not my territory. I don't know that world. Ask Tim Draper, ask someone at Sequoia. That's not my world. My world is rough. It's often a science project, and It's like, how do you get a company from a science project to, to a real company? And there's a lot of that at these accelerators. So now I forget your question. Oh, sector. Yeah. So, but you kind of figure out what you like and it changes. So I would say that we have like 5 funds. It's crazy, but I used to say the first fund, once it hit 25 companies, I couldn't fit it in my file drawer. So I stopped. And then we went to Google Drive. So it didn't matter anymore, but I still like that kind of size. So that one is a hodgepodge, stage and sector. And it's our best fund. Like that fund, if I can kind of brag and, I'm predicting, I don't know, but it's probably gonna be like 12X. I mean, I know it sounds crazy, but that's pretty informed, 12X, not including a carry, because we don't have a carry. We just invest our own money. So what's happened since then is I like science more, even though I was an English major at an MBA. And it's partly because of the accelerator. So I'm really drawn to science because to me, it's the most disruptive and it's the best moat. So it doesn't really matter whether it's in life sciences or something else. We actually created a fund called Deep Tech and another one called BioTools to be able to put these things. So we have a sort of quantum ready company going into Deep Tech. And in BioTools, we have companies that basically are helping pharma, biotech companies accelerate the process. So like drug discovery or a company that makes peptides, if Twist, like if I was lucky enough to invest in Twist would have been in this thing. So, I kind of know what I don't like. I don't like to go into super crowded spaces and try and pick, I would never do scooters, even though I know people have made millions on scooters. I'm not going to touch scooters or just plain drones. It's just not too crowded. I love robots though.
No, I love that. And it's good though that you're finding these niche spots, going after them. Now, does the rest of your team on the consortium side of the 7 is How do you regulate that so that if you're all over robots and everybody else is like, you know what, I
Well,
just want to go into deep tech?
happy you asked that question. And it's such a great structure. And I didn't even appreciate how, how lucky we were. And let me answer that. So we're a ledger fund, which means that we literally pass the hat, not literally, but we pass the hat on each deal. So if I bring in company XYZ and you're in our fund with, let's just pretend it's just you and me. And I say, look, Jeffrey, we gotta do this deal. I'm gonna put in $25,000. What do you think? And you say 0. Well, that's it. And now I gotta see if the company's gonna take 25. But if you say, yeah, I'm gonna put in 50, we go back at 75. There's no rule, there's no commitment up front. You vote with your feet each time. And here's what's wonderful about it, is that our best deals, we actually go to when we have a high conviction deal, we'll go to outside, like friends. We have like a group of like friends and family that we bring into certain deals. When we go out and people pile on and we write a bigger check, those are our best deals. It's like, it's not an investment committee. It's like, for what companies are people willing to get their checkbook out? And guess what? When they're willing to do that, they tend to be the best companies.
Yep. Vote with your money. I like that. So when you do it that way, is it still based off of a 2 and 20 structure, or is it?
No, we don't have a 2 and 20. We don't have no 20. As I said, there's no carry. We just invest our own money, and our friends and family don't pay 20. We take a fee up front. We take a 5 to 6% fee, depends on the fund up front, and then that's it. And I basically run it administratively with help. We've got consultants all over the place.
But is it like an SPV for each investment, or
no? No, that's the whole beauty of the ledger fund. What it is each fund, we set up different funds, like I said, but they get unwieldy. But for like Beresford Ventures, which is our first fund, 25 companies, I think we wrote 27, 28 checks. Everyone who invests, we keep a ledger, and then your percentage. So we know which deals you should get economics in. If you invest in deal 2, 6, and 8, you only get the economics from deals 2, 6.
It's not blended, then it is based on.
Not blended. No. But if there's ever a vote or anything legally, your percentage in the fund as a whole. Let's just say we invested $2 million in that fund, and you invested 200,000. You have 10% of the shares of that fund. But what really matters to you is the economics of each deal. So you get 1K1, sorry, American term, you get 1K1 per fund, even though you might be in 12 different companies.
Okay. Now that makes sense. And that's a good balance too. Then you're actually getting paid out on the companies you invested in versus all of them. Oh, yeah. And blending for no reason, right? When you had no interest in 5 of the 7 companies.
No one's complained about the structure. I'm looking to apply it to an accelerator that I'm involved in, so that the mentors can invest in the companies.
I like it.
It's beautiful.
Well, it's unique. It's the first time I've got to hear this structure outside of doing SPVs, but hearing that structure in the US or in Canada. So that's pretty cool. So how much, and I always like to shape this around this, because I really think that a lot of people tend to sometimes not understand or utilize their background and their initial learning that they've taken to exemplify the role they're in now or the role they want to go into. So how much of your banking background really helped you in what you're doing today?
Okay. I think I would just say how much of the person I was sort of brought up to be, got exercise as a banker, and then exercised here. I would say a lot. I mean, as a banker, you have to be, it's like going to college, or, to say to college, you go from class to class. And, in the United States, actually, I heard some very, very good Canadian CEO take a blast at Americans for not coming out of college with any specialty. And I wasn't being necessarily, I'm very pro-Canadian. I didn't take exception to it in a chauvinistic way, but I just disagreed, because I'm that person, I think I'm doing a really good job at what I'm doing, and I think it serves me really well. There's actually a book about generalists, but everyone's talking about 10,000. You got to do something 10,000 times, but there's also a book talking about generalists. And also, if you know, I mean, I read and also listen as I take my walks for exercise to books on Audible, and I listen to a lot of science history, and a lot of the greatest scientists have an artistic, side to them. If it wasn't them, it was their parents. Like, they played violin or their mother played violin, or something like that. And so I think it's important to have a mixture. It's not a requirement. So anyway, in college, I had that mixture. As a banker, I had to move from company to company. I wasn't a specialist in any one field. I was a product specialist, but I had to, meet with companies. And what you had to be, what a banker doing what I did had to be, is a quick study. And I'll tell you a quick anecdote. I mean, I went to interview for a job with a kind of a small, like NASDAQ, OTC type bank in New York. And I wish I had gotten that job, because they literally, I don't think they even wanted me to, but I was like going into meetings with clients, like companies were pitching, and I was like there, and it hit me like, this is my strength. Like, I can understand like anything that someone's telling me. I don't care what the sector is, and I can get to the bottom of it and kind of like see the possibilities in it. And I honestly, I mean, I know it sounds, very un-Canadianly pompous of me, but I really think I would have been good at that job. And so it's that capacity, which I think was developed in me from, day one, as educationally. And then, I applied as a banker, and was being unutilized for a good part of my life, came back to me here. And so later in life, I was home. I just like, wow, like I'm good at this. Like, I'm like made to do this. But I always tell people, I've got no PhD, I've got no specialty. I just bring, my experience.
But that experience that you did gain through the banking side of things and your generalist mentality allowed you to build a pattern, or at least build and exercise your mind around how banking worked, how startups worked in banking, how big business worked in banking, so that when you did kind of find your way into the startup realm again, you have a pattern in your brain that's been built around how all of these things get executed, how finance has a huge impact in any business. And you can kind of help steer companies through the experiences you've had on the fraud side, through how banking is structured. So there becomes a lot of things that we don't think are actually learned, but they really were in that process, that as you were going through, you were hearing about stuff that the average person may not have ever learned. And those
But also reading. I mean, it's from reading the Wall Street Journal every day for decades, and it's a breadth of experience. Yes, look, I mean, I visited lots of plants, and I met with executives. It just kind of all sinks in. You learn a lot in business school, but and I learned as an investor, not in the early stage stuff. I'm a limited partner in a lot of companies, a lot of VCs, a lot of funds. And I don't know. And also, I've learned on the job. I mean, I'm learning every day. I mean, that's the fun part. I mean, this is work, and I enjoy it. Notwithstanding everything I said, but it's what makes it, besides hoping to make money, fun and worthwhile, is the education. And so that's what kind of gets you out of bed every morning with what's today going to bring.
I love that. 100% agree with you. It's the what motivates you, and you can find a million things. And I always I set early meetings with startups or with companies or investors, because one, it forces me to have to be on page and ready to go, but it also forces me to think beforehand. What do I got to achieve here? Why am I doing this? What do I got to get out of
this?
I
see. So like you'll have a call like at 8:30 just to like start your day with a, make sure you're
sharp.
I'll
book it at 7, and I'll do it just because it forces me to make sure that I'm on my game by 7 a.m. And people be like, man, that's early. What are you doing? And I'm like, you know what? I got a busy day, but I might not have that 7:30 meeting. But by the time that meeting comes up, if it's 2 days or 3 days from now, that 7:30 will be filled, and I will be booked until whatever time. But it forces me to make sure that that other person is just as serious about what we're doing, and that we're going to close a deal, and that they see that I'm just as interested, no matter what, that I'm going to be there and I'm going to make that happen.
I like it, because you want to make sure that your founder is serious and committed. Yep. And I actually have to like have to point out to some founders that this is not for fun. We're not here for fun, and I don't really need to hear about how much they enjoy their job or anything like that. To a degree, but like this is about executing and it's just serious. When you're dealing with other people's money, it's really serious, and that's the way I feel. I mean, I feel like a steward of other. I can rub people the wrong way, even my own team, because I'm so serious about this.
We'll put it this way too, that who can't be at a meeting at 7 a.m? What do you have that you can't attend?
Well, I'll tell you, because I wouldn't necessarily take a meeting at 7 because I can't sleep. So my sleeping pattern is so unpredictable that my best hour or two of sleep might be starting at 6 or 5. I might be up for 3 hours in the middle of the night, but that's age related. I mean, I'm in my 60s. So yeah, if I were in my 40s or 30s, which I imagine you are, yeah. I mean, shoot, I had to get to the bank at 7 for a long time. So
yeah,
I hear you.
Right.
But remember, when you get older, just think back to what you just said.
Well, agreed. But I also think that what it does is it lines up your seriousness too. It shows the startup that you're willing to adjust. If your schedule is busy, you're willing to slot somebody in early just to make sure you're fitting them in because you want their success. You want to make sure that, like you said, you're investing other people's money, that they're serious on both ends. And I think
that's what I'm saying. You're aligned in that way. For me, it's more the weekend because I work, 7 days a week. And so if someone's willing to call me later in the evening, then I take that as a good sign. Or if, I'm often saying, look, I don't schedule as many calls on the weekend. Can you talk? And if they take that, I mean, I understand that people have kids and stuff, but it's a good sign to me. Yep.
Agreed. Yeah. All those things help, right? Every little bit. Brilliant. Well, I think now what we're going to do is we're going to kind of transition into our questions, which are rapid fire. So we'll ask a bunch of them, and then we're going to get into some more personal stuff. Yeah, we like to learn everything about you. We want our community to be able to really dive into learning about how Jim thinks and what Jim does, and that's the way we like to roll. So
okay.
And you talked a few about already have mentioned a couple of these answers, so some of them might be just re-emphasizing them again because it's all in that quick segment. But so, what is your favorite part of investing?
This kind of investing. Like I said, it's the education and then those aha moments when it's more mentoring, but when you really help a company sort of understand their own business better. It's usually strategy. That's usually where I'm most helpful.
I love it. We think alike, same way. It's that excitement you get at the end of it all too. How many companies do you invest in per year?
Per year? Well, I only invest through Beresford. So like I said, we're sort of around 30. I mean, I'm in 130, whatever. And then, I invest through AngelList for the education of it, just to kind of know what's out there. So I'm in, and if you include my LP investments through funds, so they're not direct, but I'm in probably like 350 companies.
Amazing. It's huge. And you mentioned a bit on the verticals again, but just to reemphasize the verticals that you like and focus on.
I enjoy life sciences, so therapeutics to be specific. We don't invest a lot in therapeutics, but I really like, I'm literally reading Janeway's immunology. I read books on the classes I didn't take in college and, in science. So I enjoy those the most, but I'm sort of, I stumble around in those. What do I like best? Like I said, I would just say the science, but look, we have direct to consumer, we have apps too. I mean, I like it when they do well. I like it. I like when they grow fast. And one thing I have to say, and I would say this to a lot of people, I'm sure on the phone, the Valley venture company, firms, they can basically limit themselves to fast growth companies because that's what's there. They can be very picky. Don't be disappointed if you can only invest in companies that are grinders and they're going to grow slower. It may be that they're selling B2B and long sales cycles. People say, well, don't do that. But guess what? Unless you're in the Valley, that's a lot of what you're going to see. And so you should take the best of those. And that's where the patience comes in.
I like it. What's your timeline for investments from the first time you have a conversation to the end?
To the end when it exits, or the end when we write a check?
When you write a check.
Well, again, I mean, I should be embarrassed, but I have to get to our strategy to explain like why we do what we do. But I mean, we have done deals in like 2 days where like I'll meet a company, say it's CDL, and I'll be, oh my goodness, this company's great. And I'll, maybe not 2 days, 4 or 5 days. And then they'll say, like, what's your time? Like, oh, we're closing, whatever. We got like 50,000 left or whatever. It's like, great. I go to my team, pitch. I remember there's one company we did that. I was so proud of my team. We got on the phone. Everyone loved it. I think we wrote a $75,000 check, and like we turned it around. We wired the money out like, 6 days later. It could be that to, it could be a year. I mean, it depends not so much on us as it does on the company and on their round.
Okay, love it. Outside of the quick DD that you guys go through, is there any factors that really shape and prepare the investment that you think really stand out? They need to have a shareholders agreement and we're in. Like, is there something that really stands out?
Well, documentation wise, our lawyers, they are like our investment committee, really. They'll tell us. And like, I'll tell you, like, it's got to be, we don't do common. We've walked away from a lot of deals that are common, just won't do common, we won't do uncapped notes. And then the company docs have got to be good, and the deal docs have got to look good. And that's where we walk. We are easy. We're kind of pushovers when it comes to investing in a company based on its, on the face of it. But we're really strict on the documents, and we point out to bigger funds than us what's wrong sometimes in the documents.
Perfect. No, I wholeheartedly support that. And you mentioned before that you don't like to lead rounds, so that's good. And you mentioned a little bit about the preferred terms. Maybe you can emphasize a little bit more on that strategy side that you were just mentioning, how that works and how you guys get through companies really quickly, and then end result, if it's pref shares or if it's just pure equity, what is that favorable terms that you guys go for?
Well, we're not looking for special terms. I mean, I've been in an angel group and I've seen other angel groups, who basically try and, play, I think is a weak hand and overplay it and ask for ridiculous thing, 50% warrant coverage and, 2 times liquidation, participating, it's like, no, we don't want that. We're not saying the terms. We just want to be preferred. So we want our safe to be post money if possible. And that's something we're insisting on more often. And I can, what that means, but I can explain it if necessary. So we want post money safes. We want them to say that they're going to convert to preferred. And that, the Y Combinator safe that people are using these days. So we're okay about safes. We did kisses too, as long as they have this in there. Or a note that converts to preferred with a post money cap. And if it's a price round, it just has to be price equity. So, that means it's going to, usually they have 1 times liquidation preference. We're not looking or expecting more. I'll tell you this is, if a deal has 2 or 3 times liquidation preference or lots of warrants, that usually means that the issuer, the startup is desperate. And I would say that that's a pretty obvious red flag, and you should probably walk. And I can say I haven't listened to my own advice several times and been burned.
I will highly agree with that. And I think that's just diving in a bit more, like you said, and trying to learn more about what the hustle is for. Like, why are they trying to close? What's the reason? Sometimes it could be that they're trying to grab inventory. They have other issues that they're working through. But a lot of the time it's just trying to buckle through a bigger problem that you don't know about.
Yeah, or a lot of times it's basically the earlier investors. I mean, it could be a recap, and it's okay if it's a recap. Just tell me it's a recap, and I got to understand what. But a lot of times it's early investors who are desperate to keep the company afloat and are telling the founder that he or she's got to sweeten the deal to get them in. Yep. I say a lot, but I've definitely seen that scenario.
No, it makes sense. And then outside of, do you take board seats?
No.
Okay.
No one asks us to, and you could say it's because we're nothing special, and that's fine. But there's a liability issue, and we don't have insurance for that. And then it's really just a tail wagging the dog. If you're writing smallish checks, it's not right to have a board seat. That's a whole other conversation. I mean, boards and founders to me is like, it's such a big part about being an early stage investor. I actually would like to be on a board because I think I would be, because a lot of board members are there protecting their own interest as opposed to all the shareholders' interest. And a lot of board people don't really understand startups.
True. Yep. Well, we try to, in our case, because of a fund, we try to put our investors into boards, and we do that so that one, they can in the board or advisor, and so that they can provide coaching, goal setting, and drivers back into the startup, but also at the same time, because they're investors, they're angels or VCs, but at the same time, they also can report back into the fund. So they kind of work with them to work with us. And
Right.
It provides a nice level of management. But a lot of the time, it's usually self-fulfilling boards, and it's unfortunate, but we do it to benefit them, but also support what we're doing. And we tell them that we don't want to be in your board after 2 years. So you need to be growing so that you're not talking to us. If you're talking to us in 2 years, we're not doing the right.
Wrong, right?
Yeah, exactly.
I hear you. And how big are your checks?
They vary anywhere from, we try to make sure we're putting in 100,000 as a minimum in a pre-seed and seed. So we're trying to push that target higher so that we'll be doing 100 to 250 on each check. So we wanted to have more of an impact because of the area of focus that we're in. So we try to push that a little higher.
Got it.
But so outside of the investment strategies and all these great things you guys are doing, is there other
we do a lot of bad things too. Don't get me wrong. We're only right 30% of the time in this business.
Well, that's still 10% or 20% better than most. So that's a good thing. Do you look at other ways to help the startups too? So once you've made that investment, what other kind of on?
We only try and help where we think we can help. So I try not to overpromise and underdeliver, though I will confess sometimes it happens. But when you have over 100 companies in your portfolio and you know a lot of mentors, through these different accelerators, there are usually some ways that you can connect people. Often it's founder to founder. So we're sort of connectors, more than anything, and every now and then help on business development. And look, when you have so many companies, you can't be on boards, even if they wanted us, we couldn't be on a lot of boards. But I am sort of the founder whisperer for a few companies. I mean, some of them I'm just friends with and we just talk. And I think it's just like when they're winding down at the end of the day, they might talk to me or whatever. But I'll throw some advice. But there are a couple of cases where, like, there was one company, remember, like you said, like I was sort of like on that early board until like the next round, and then I got replaced. But I was like someone who was there, once every month or so to just kind of talk to the founder. There's another founder I talk to every week, and it's serious stuff. I mean, actually, it's much closer to banking, but like I'm helping them make serious decisions. So it really depends on the founder. If they seek it out, I'll offer. But a lot of times it's someone to talk to and just someone who's just got some experience and wants, they just want to double check their math. You're helping them check their math, I guess.
I love it. And I wholeheartedly agree. Again, that's some great advice. So we're going to kind of shift a little bit now into the personal side.
Right.
And we built this segment in because I found that I was having these amazing conversations, and I'm not myself very personal because I always tend to wait for someone to ask the question, then me to ask the questions. But through some of the startups we work with, I actually learned some real easy ways to kind of segment into these things. And
segue into this.
Yeah, segue right in. So it was brilliant. So I started to come up with my own kind of questions that really opened this up, and I felt, man, this is great. So I've been in the last, 20, 30 segments, I've been using it, and I probably explain myself because of the shock that I go through every time I have to ask a personal question. So this is me working my way into it.
I won't answer if it's too personal.
Oh, no. It's nothing crazy like that. But, and one that I asked to, when I was teaching, I asked a lot of students, and some of the startups, I'll ask them this. So, and you made me think of it. So now it's going to become one of my questions going forward to all of the investors I speak with. But what is your superpower?
Well, I don't know that I have one, but I would, if it's sort of like, if you name it, it's probably not right. I think it's but I think it's the ability to quickly grasp what the company does, as I said earlier, and then kind of in a very optimistic way, imagine where the company will be in 5 years. It's sort of a visualization. Does that make sense? Like
Yep.
seeing into the future. And I don't mean to say I know what the future is going to be. I'm not, crazy. But it's just like, what could it be? And believing in it. It's like, and
Huge.
sometimes I believe in it more than the founder, which is a little bit nuts.
No, that's perfect. You need that. And that's the whole reason why these founders are calling you, because they need that support. So that's brilliant. Favorite sports team?
Oh, the Miami Heat. That's the easiest question you've asked yet. I'm like a sick, stupid fan. It's disgusting. And I'm ashamed. I behave very badly at games.
Fair enough. They're okay. I wouldn't say they're the best team in the league.
No, I didn't either.
But they've certainly pulled some great teams over the years. So I can say, with Bosch being sent over there a long time ago and stealing some of our prime players.
Yeah, I know. I'm sorry about that.
It's been a good run.
Well, you guys got your championship, and I was pulling for the Raptors big time. I was just sick of the Dubs winning all the time. So
agreed.
I wasn't happy that all those injuries happened, but I was really happy for Toronto and the city, because I was spending a lot of time there.
Yeah, it's really pulled it through. So, but Miami's always had a great team. So always competitive in all sports, but especially in the NBA.
I wouldn't say we're competitive in all sports. You go too far there, but
Well, you guys try. You've got your football. You guys are
football. It's been a dry spell, and it's been hard. And baseball, I don't follow the Marlins really, but the Marlins have been pretty much in the basement for a long time. But the Panthers have been.
They were up and down too. Yeah.
Yeah, well, the Marlins won twice, but that was before I lived here. I was in New York, in those days. So I wasn't pulling for the Panthers.
Oh, okay.
For the Marlins.
Yeah, no, fair enough. All right, so the next question. Favorite movie, and what character would you play?
Oh my God. I used to act. I talk about theater. I used to act or act and write. So that's another thing, I acted with some good people in high school and college, like James Spader.
Oh yeah.
Is one, he's in something called Blacklist.
Yep.
And though she would completely deny it, but I'm having a senior moment. It'll come to me. But an actress is a TV show, very, Dana Delaney was a name you probably wouldn't know, but a big TV actress in her day and stuff. So which movie is my favorite movie? Oh, I don't know. I'll tell you what, I'm going to answer the question and in a different way. The TV show I love best, the series is Mad Men.
Mad Men, okay.
Mad Men. I would definitely play Jack Ham's character.
Nice. All right. Hey, that works the same way. There's still a good movie or a good vibe. And
people don't go to movies anymore because of COVID. So if you haven't seen Mad Men, go watch it on Hulu or Netflix or whatever you guys have up there.
All right, I'm going to watch that. And I haven't actually seen it yet. I've heard great things about it. But what I like about it, the character that usually you pick, usually somewhat defines the character who you kind of represent yourself. So I get to learn a little bit more about you by watching that. And there's been some great suggestions. It looks like I'm doing this just so I can figure out what movie to watch next, but it's worked out quite well. So I'm on the Indiana Jones series right now. So I just flipped through all these different vehicles to figure out how people are inside of them. So it's pretty cool.
Well, Mad Men, Jack Ham in Mad Men is Jack Ham. That's a football player. But John Hamm, I think he's a pretty,
John, the main character.
Don Draper is a character. Yeah, he's messed up. So don't go too far with the parallel there.
No, fair enough. Well, I want to say that it's been a pleasure chatting with you, Jim. I've learned a ton. I'm sure the audience has. You've got a lot of great ways of doing things. I love the way that you've taken what you've been through and turned it into a fantastic investment firm. You're superseding all the investments that most groups make in a year. So you guys are hustling hard, and I think that's Awesome.
Yeah, and we have a good portfolio. I don't think I stressed that enough. I mean, you know, we're not specialists or geniuses, but we so far it looks like we've got, no one would trade our portfolio. So
I love it. And that's important. So there's one last question I'll ask, and then we'll wrap it up.
Mhm.
And the question is that, you know, throughout the time that you've been working with startups and you've been in this space, is there a story that just pops to mind that you really think is amazing, that, wow, I can't believe these guys did X or Y, and that you want to share with the community?
Oh, like I said, I'm not good at recall. Help me out. What would you like to hear? Give me, I mean, I'm sure I can think of 100, but
Well, there's usually, I don't know, that story where the startup was just trying to find market fit. They were on the verge of
oh, so you mean like a serious one, like a good story, like a business story.
Yeah, and they just pulled it off, and you couldn't believe they made it. And
Pull the rabbit out of the hat. A good pivot.
Exactly.
Golly, there've been a lot of good pivots lately. This is a company I don't know them very well. They're in our portfolio, but I can tell their story. Just because it's a pivot story, and you know, a typical thing that angels and VC say is, you know, we like our founders to be scrappy, which is another way of saying tenacious. They're not going to give up. So again, I don't have a lot of detail, but this company was in the travel space. It was a young woman, still a young woman, who actually one of my partners really liked. He just said, she's got it. And so I said, okay, you know, I'm willing to bet on this. It was through an incubator or, you know, a fund incubator that we've done a lot of deals with. So it was vetted and all that. So COVID hit. They were literally at a conference for like 500 startups for travel companies in Europe, and or TechCrunch or something. And they immediately, I would say immediately, but they just quickly decided to jettison the whole travel thing. And they created this sort of office. It's for office managers. It's sort of like a one platform that combines. It's like keeping your to-do list, like your tasks, and it brings in like every single, you know, app or program that you would have into one. And they, you know, they're slowly building the business, you know, building it out. And so, you know, it's not really a personal story for me, but it's just an example of, you know, two young founders just pivoting on the fly. And actually, I have a call with them tomorrow. They're doing a raise, and I can't wait to hear more about what they're doing. So,
I love it. You know what? It takes those moments and the big ones that hit you like a ton of bricks to figure out that you got to make a little bit of a change or a big change. But it also comes down to investors believing in them and knowing that the founder is the driver to all of this. And if they're a good founder, then they're going to be quick on their feet and they're going to make the change they need to.
Helps to be young, because even if this failed, they knew that they could come back and start a new company, you know, before they were 30, right? So
Awesome. Well, Jim, again, thank you very much for your time. And what we love to do at the end of our segment is we like to give you the last word. So anything that you want to share to the audience, to investors, to startups, founders, anything you want to share from advice, I turn it over to you. But
oh man, I don't have much advice. Just don't be too full of yourself, I guess. And you know, I probably sound like it. You know, we try and lead with humility, and you know, we're a probability investor, so we think luck plays a big part. So I guess maybe it's just realize when you start to, you know, things are going your way or not, that, you know, luck is playing a big factor. Don't be hard on yourself.
I love it. Awesome. Again, thank you very much for your time. Oh, that was awesome. Jim was fantastic. Shared a lot of great insights, and I learned a ton. And I think that's what the key is, that we all get to learn a little something every time we talk with someone. I think, you know, going forward, I think Jim made a lot of great points, and even from a minimal to a lot of deep dive information, it's always going to be helpful as an investor. I love the way that they do their investing using the ledger side. Very cool way of doing it. And I think, you know, that superpower question, I'm going to have to ask that going forward. So thank you, everybody, for joining in today and listening to Ask an Angel. And we'll see you guys soon. Please like, share, add, all those great things on social media, and looking forward to seeing you guys all soon. Thank you.